Namaste and good evening, good morning and good afternoon depending upon the geography that you are situated in at present because nowadays geography is history. On the behalf of Ashutosh Financial Services Private Limited, I sincerely welcome and thank the knowledge-savvy persons who have honored our invitation and joined us for the presentation on the topic Union Budget 2022-23 Income Tax and Investments Viewpoint. Over the years, the Union Budget has been the focus of the entire country, right from the common man to all those who are engaged in business and industry, financial institutions, foreign institutional investors, etc. Every year in the Union Budget, the central government makes important announcements and provisions affecting the economy as well as the taxation and financial laws. These announcements of the Union Budget give direction to India's economic activity, which need to be understood and analyzed properly. Today's presentation will be addressed by Mr. Dakshish Kothari, who is a tax and financial consultant and MD and CEO of Ashutosh Financial Services Private Limited. He has been providing concise and accurate analysis on the Union Budget for the last 16 years. Today he will complete his 17th consecutive year on presenting analysis on the Union Budget. Before we move to the core presentation, we will play the corporate video of our company and also the introductory video of today's speaker, Mr. Dakshish Kothari, after which we can begin with the core presentation. After the core presentation, we have arranged a short question and answer session. In case you have any questions, you can ask the same in the meeting by clicking on the option called Raise Your Hand. Alternatively, you can also type your question in the Zoom chat option or in the YouTube comments option followed by your full name. So without wasting much of your precious time, let us move forward towards today's presentation. Thank you.
Years back, late Mr. Dinesh Kothari started a firm in the name of Messrs. Kothari and Company to provide tax and allied laws advisory services. Later in the year 2001, the activities of the firm got expanded into a corporate entity in the form of Ashutosh Financial Services Private Limited. Over these years, the company has emerged as a prominent player in the field of finance and taxation. The company operates with a quality management system certification of ISO 9001:2015 and is now a complete financial services solutions enterprise. Ashutosh Financial Services Private Limited is presently serving through its 4 different services, namely Ashutosh Investment Services, Ashutosh Insurance Services, Ashutosh NRI Services, Kothari and Company. Ashutosh Investment Services, which is in the activity of connecting people with investment opportunities for Indian markets. Mutual funds for investing in equity, debt and hybrid. Portfolio management services for investing into equity shares. Alternative investment funds for listed and unlisted equity shares. Direct investment in shares of unlisted companies. Advisory stock portfolios for investing in curated portfolios of equity shares. Investing in bonds, that is tax-free bonds, taxable bonds and capital gain bonds. Investing in fixed deposits of top-rated corporates. And investing in precious metals through sovereign gold bonds. For investing in global markets through direct investment in shares of foreign companies and ETFs, and precious metals through ETFs. Ashutosh Insurance Services, providing insurance solutions for life insurance for life risk coverage, health insurance, mediclaim and personal accident, insurance of assets for all types of risks, insurance for liabilities, retirement and pension planning needs, and investment through insurance for guaranteed returns and ULIPs. Ashutosh NRI Services is a one-stop solution for NRIs to address the needs of investments in mutual funds, EMS, AIF, unlisted stocks, foreign equities, and advisory stock portfolios, insurance for life risk, health, assets and liabilities, retirement planning, and investment through life insurance, complete planning and compliance for Indian income tax, advisory under FEMA and RBI regulations, and complete support for compliance related to foreign tax laws in respect of Indian incomes and assets. Kothari and Company works as a solution house for complete income tax planning and compliance, and estate planning for advisory related to inheritance laws and preparation of company is a unique setup which is truly a one-stop solution for all the financial and taxation needs of the client. The company enjoys a state-of-the-art infrastructure facility having its office in the middle of Rajkot city, spread across 4,000 square feet area consisting of separate setups for each division. The company has a fine mix of personnel from financial and legal background like chartered accountants, lawyers, certified financial planner, and management graduates to form a dedicated team of skilled and qualified staff. The team works under the dynamic leadership of Mr. Dakshesh Kothari, who is the MD and CEO and the other directors of the company. All the divisions and departments manage their operations with high-tech versatile softwares, and the entire IT infrastructure is connected with integrated file server for seamless exchange of data with security and regular data backup facility. The company has a fully equipped conference room with projection and video conferencing facilities, which makes dissemination of knowledge, information, and interaction convenient. The company has its regional office at Ahmedabad, which is the emerging metropolitan city of Gujarat, to facilitate the clients. The company website www.ashutoshfinserv.com and mobile application Ashutosh Finserv gives an overview of the happenings in the world of finance and also a useful client user interface. We operate multiple investment management softwares for managing our clients' investments, having interface with our website and mobile app. With the help of our website, reporting software and app, our clients can carry out complete paperless investment transactions and can have access to their investment portfolio on real-time basis. We regularly update our clients with latest happenings from the world of finance and taxation through digital mode of interactions using YouTube videos, WhatsApp broadcasting, and sharing the updates on social media, that is Facebook, Instagram, and LinkedIn. The company has been conducting presentation on analysis of the Union Budget since last 16 years, organizing series of presentations for non-resident Indians on aspects of taxation, regulations, and investments since last 4 years. And the company is also arranging presentations for various sectors of economy and society by covering topics of vital importance related to finance, taxation, and estate planning. The company serves to more than 3,500 satisfied clients spread across the world and is actively maintaining business relations with many clients and groups for more than 60 years. Ashutosh Financial Services Private Limited is growing as a complete financial solutions enterprise with its presence felt not only in India but also globally. Mr. Dakshesh Kothari is a tax and financial consultant and the Managing Director and CEO of Ashutosh Financial Services Private Limited, which is an ISO 9001-2015 certified company with prominent presence in the field of financial services. He specializes in the fields of income tax, FEMA, trust laws, estate planning, and foreign tax compliances. On the financial front, he specializes in investment services and insurance services. He advises companies, trusts, high net worth individuals, and non-resident Indians across the globe on financial and tax and allied laws related matters. He is a trustee of various charitable trusts. He has been involved with a number of social service projects of Rotary Club and is a Paul Harris Fellow of Rotary International. He has been presenting analysis on the Union Budget since last 16 years. He has been delivering series of presentations on taxation, regulations and investment aspects for non-resident Indians since last 4 years. He has also been addressing doctors, businessmen, industrialists, taxation consultants, chartered accountants, company secretaries, NRI and postgraduate students of diverse branches on subjects relating to finance, taxation and estate planning to make our society financially literate. His articles on financial subjects are regularly published in renowned newspapers like the Economic Times, Mint, etc. and also in magazines like Dalal Street. His interview was aired on ET Now as a mutual fund industry expert in the program named Swatantra, which is one of the most acclaimed investor education initiative of our country. He has also addressed a program dedicated to NRI on a leading Gujarati TV channel in Ahmedabad. He is a 360-degree versatile personality in the fields of taxation and finance, which makes him a unique and truly a one-stop solution provider for a wide range of financial and tax-related matters.
Hello, everybody. I have been watching all these years that the moment the union budget is about to be presented by the finance ministers, and thereafter the budget is presented, and all the discussions start in the television, in the newspapers, and now very much also in the social media. For 4 or 5 days every year, the entire country gets immersed into the world of finance, economics, and taxation. And I think that is very important, that everybody, whosoever is into any business, profession, or maybe even investments, they should take interest into whatever is happening in the economy, in the world of finance, and what are the tax provisions which he will be subjected to. And it's really heartening to note that you have all spared your valued time in joining this presentation and listening to what is in store in the Union Budget 22-23. As has already been said, that we have been presenting union budgets and the presentation on the union budget, to be precise, since last 16 years, and this is the 17th year of the presentation. What we try to do in this presentation is that we give a complete overview of the economy, the state of the economy in which this budget was presented, and thereafter we talk about what all has been provided in the budget in general on the economic front, and especially what are the changes which have been proposed in the finance bill on the income tax front. And we try to cover all these things absolutely comprehensively looking to what all provisions would get impacted or what all provisions would impact people who are in general into a business or a profession or any investments. So first, we'll start with what is the state of the economy. As I said, the backdrop in which this budget was presented. Next. So first, let us look at what are the global factors which are around us, which is going to impact the state of not just the global economy, but the economy of India as well. Inflation has been rising across the globe, and this is on account of the supply chain disruptions, the movement of goods, services, people have been impacted since last more than 2 years on account of COVID. Production disruptions have happened. So many plants, so many mines, so many shipping lines, they have closed, or they have reduced their production and they are not working at their maximum capacity, and production has been disrupted. Then there is an issue of greenflation. This is a new concept. Greenflation, under which people say that we have been making a lot of investments into green energy or green ways of operating or living life. These investments are investments which eat away a lot of resources, but they produce their energy, their resources over a period of time. This leads to a lot of demand of all these equipments. Say, if we put solar power panels, there would be a lot of demand of so many things when we put those solar power panels. But the energy that is emitted out of those solar power panels take a lot of time to break it even. So this leads to a lot of demand of so many commodities, and this leads to a certain level of inflation when it is magnified across the globe. This concept of greenflation has led to inflation in the world at large. Then one of the most important things, because of COVID, all the central banks in the world have reduced their interest rates and have gone for an easy liquidity policy. So this has led to a lot of money chasing the goods. So this was on account of whatever is happening on the inflation front. Then lack of investment into core industry. Last 4, 5, 6 years, what has happened is that the commodity prices and the prices of commodities, especially like oil, have not been something which has found favor of global investors. So what has happened is that inflation has crept in the pricing of these commodities because investments into these core industries have been neglected, and people have been investing more and more into new age industries and new age kind of business activities. So these core industries remain a little neglected, and investment into that lack of investment led to a situation where supply was not adequate, which leads to the price rise. Then when we talk of the global economy, geopolitical tensions across the world, the way China is behaving across the globe in terms of their military might and the economic might which they have developed across all these years, the issue of Ukraine and Eastern Europe, the way the political situation is in the Middle East, all these things impact the economy in terms of prices of core commodities. Then now when the COVID situation is little easing up, all the central banks in the world have started looking at a scenario where they would like to raise their rates of interest, and this will lead to a lessening of the supply of money, and which might lead to a next level of difficulties which might lead to stock markets market be on a decline, because there is a lack of supply of easy money, which it used to be since last a couple of years. Now, when it comes to India, manufacturing in India is now ramping up very strongly. India's relationship with China, whatever has happened in a couple of years, the world's relationship with China and their strategy of China plus one approach, where they want one more strong supplier across the world, and that policy of the world at large of developing one more supplier over and above China is ramping up, or rather developing manufacturing in India. To support that cause of manufacturing, the government has been very lenient, and they have been rolling out PLI schemes, which is production linked incentive schemes. And they have launched this PLI scheme supporting at least 14 sectors, right from sectors like automobile components to textiles to everything, where the entire manufacturing chain of these sectors were completely destroyed, and India had become completely dependent upon the import of all these items. So now manufacturing in India is picking up big time. There is a lot of investment which is coming into infrastructure. This year's budget will deal into the proposals. There also the government is very keen on spending a lot of money onto infrastructure, and the capital investment of the private sector is also picking up. Services as an industry in India is picking up very strongly, and especially the services which are booming in the new age, which is the COVID era, where information technology and related services are doing really fantastic, and India is gaining prominence in that. Contact-oriented services like hotels, tourism in India are right now not doing so well for obvious reasons. Then the consumer demand in India, it has been observed is that since last quarter, it has been a little slackening, for the reason that the prices of so many of the commodities, and which has led to the price rise in the end commodities, have slackened the demand of certain products, and that is impacting the corporate profitability, especially in the FMCG and the consumer-oriented industries. When we look at the government finances are in a very comfortable shape. They have record collections of direct taxes and indirect taxes, and this is predominantly due to a lot of efforts, right from starting from demonetization and till date faceless assessment and every other thing, which has increased a lot of compliance. India is emerging as a preferred destination for investments in comparison to China. So anywhere somebody is planning to make investments outside of their country, the preferred destination once upon a time used to be China. Now India is also looked upon as a preferred destination for several reasons. The way things have happened in China, there has been an attack on the technology companies by the Chinese government itself in curbing their rise, and it was a sudden move which has astonished the world. There is a sudden environment concern in China, and China has been demonstrating a lot of expansionist foreign policy and transgressing into territories of people, which makes them a little unfavored kind of a country. So all these have led to an India advantage. Thereafter, India has seen a massive rise in the entire startup ecosystem. There are more than 10,000 startups which have been registered in last 6 months. And the flow of private equity investments into unlisted companies has been really massive. And today, India is the third largest house of unicorns across the world. So India has the third largest number of unicorns in the world. So this is really creditable, and this really shapes up the way the Indian economy is. Now, let us look at a few figures which will give a perspective as to how the country is and in what backdrop this budget has been prepared. When it comes to the GDP growth in India in the year 21-22 is phenomenal. It is estimated to be at 9.2%. And for the year 22-23, which is the coming year, it is estimated between 8 and 8.5%. The inflation in India, when we compare it across the globe, is quite under control. Obviously, there is an inflation, and in the year 2021, 21-22, it was beyond 5%, which is not a comfortable level of inflation. But there were several reasons, as we have discussed in detail, on account of supply shortages, supply disruptions, and on account of a lot of supply of money. And this inflation is not just the Indian-driven inflation, but the global inflation which is impacting India. Then the most discomforting part, the way India is placed, is the rising prices of crude oil. As on 31/3/21, the price of $1 of Brent, one barrel of Brent crude was $77.78, which is $77 as on 31/3/21. In just 1 month and 5-7 days, it has spiked to 92.97 what it was yesterday. So this is a massive rise in the price of crude oil, which is going to disturb so many of the Indian dreams when it comes to economics, on the government front, on the corporate front, and at the personal front. But as far as the prices of crude are concerned, we are helpless because we are substantially dependent upon the imported crude oil. The forex reserves are at a very comfortable, healthy position. Year on year, there is an increase in the forex reserves. So India is very well cushioned to meet any eventualities of any imports as it might be required. On the exchange ratio front also, India is doing quite well. From 2014 to the year 2021, the depreciation of the Indian rupee vis-a-vis the US dollar has just been 12.41 rupees, which is just 2.63% on a CAGR basis, compounded annual growth rate basis, across a period of 7 years. This shows the strength of the Indian economy, the way the growth of the Indian economy is happening, the way the economy is moving on the inflation front, and the way the government finances are being managed. This is the reflection of the strength of the Indian rupee. These figures show that the foreign institutional investors, for their whatever internal reasons, have been net sellers or massive net sellers in the year 2021. But domestic institutional investors, which are mutual funds, insurance companies, and financial institutions, they have been strong buyers of Indian equities. And the Indian equity cult is developing so well, so fast, and deep-rooted across the masses. And Indian industry, Indian manufacturing, Indian stock market is now not dependent or reducing its dependence from FIIs to the domestic money, which is a very encouraging sign. This is clearly reflected in the way the systematic investment plan SIP flows have been. What is very interesting and encouraging is that in March 2020, which was the peak COVID time, and March 2021, that was also a time when there was a COVID fear, but still there has been, or there had been, an increase in the extent of SIP flows in the economy, and that shows the maturity of the Indian investors and the confidence that the Indian investors are putting in their own country by investing in their own stock market. Presently, 11,000 plus crores per month is the SIP book, and that is the amount which is going to get into the equity markets on a sustained basis, and that is going to channelize into the development of Indian trade and industry in a very big way in times to come. Now, let us look at how the growth of the top 20 economies of the world is going to fare. And on the top of the table is India. Out of the top 20 economies of the world, India is expected to grow at the fastest rate of 8.5%. So this is really something where all Indians need to be proud of, and this is to the credit of all the Indians and the way our government has been pursuing its economic policies. On the interest rate front, the interest rate in India are the repo rates I would refer to are at the rate of say 4%. And when it comes to countries like US and several other Western economies, they lend absolutely for free so that their economy is primed up. And countries like Switzerland, you can see that there is a negative rate of interest. Hereby, what it means is that the central bank of the country says to their people at large that take money, buy goods, keep the economy floating and strong, and return maybe a little less over a period of time back to us. So this is the kind of despaired situation certain economies are into to keep their economy afloat. So India is in a scenario where the interest rates are quite comparable to the other emerging markets like China, which is in the range of around 4%. So the complaint which Indian manufacturing and Indian industry had all these years, that the cost of funds in India is on a very higher side in comparison to other emerging economies, is now no more quite valid in the new scenario. Now, if we look at the stock market performance, India has been doing good in last 1 year. These are the statistics as on the 1st of February, the day on this the budget was presented. There have been certain ups and downs thereafter, but by and large, this is what is the picture, that Indian stock markets have been doing comparatively good vis-a-vis the other markets, which are the emerging economies like China, which has grown negatively, and the other developed markets of the world as well. Now we'll go into what has been proposed in the Union Budget 22-23. As far as some important announcements which have been made in the Union Budget, and a few of them I would like to bring to your notice, which are quite important when it comes to understanding the way the direction of the government is, are that there has been an increase in the defense spending, quite understandable. The needs of defense cannot be ignored. But what is very interesting is that out of the total defense outlay, 68% of this amount is supposed to be spent in the domestic industry. And this is unlike what it used to be in earlier times. And out of this 68%, 25% are the purchases which the defense are going to make from the private sector. So these are path-breaking announcements, and this is going to lead to a lot of fillip in the manufacturing and creating a lot of jobs in the economy in times to come. Then the health sector allocation is getting increased by 16%. India has announced that it will be rolling out a digital rupee, which is a central bank digital currency. So when a central bank of a country itself starts issuing a digital currency, then it is called a CBDC kind of a currency. And India has announced that it will have its own digital rupee, which will be at par with the rupee, and it would be controlled and monitored by the Reserve Bank of India. In the budget, it has been announced that fintech and digital economy is going to be the focus area. So every other action which is being done by the government, may it be health related networking, may it be anything for that matter, it would revolve around fintech and digital. Then there has been an announcement which is made that electric vehicle battery swapping policy will be announced, and its interoperability standards would be rolled out. So what would happen is that this will lay the foundation for a complete EV infrastructure in the country, which will change the face the entire automobile industry and the automobile network in the country is working. And last but not the least announcement, which I find it very interesting, very important, is that India would be introducing e-passports from the year 22-23. So now these e-passport, the way it works is that it would have a chip on the passport, and we need not get our passport stamped. The moment that chip is scanned at the immigration, when we are leaving or entering the country, the system will take note of that this person has entered India or this person has left India. So that will electronically track the number of days of stay inside and outside of India, and all the government agencies would get an information how many days that person was in India, outside India, in India, and whether that person right now is in India or not. This is what are the figures of the budget. I would not like to trouble you with so many figures, but at appropriate places, we have made those red round circles. The tax revenues have been progressively increasing, which is very, very heartening to note. And it is really worth appreciating the way the country is being administered on the tax revenue collection front. It was estimated in the last budget that India would have a certain level of tax revenues. That target has already been crossed, and now in the revised budget estimate, it has been substantially increased. And in the next year budget, it is being still increased, and it is being very widely discussed and widely expected that this budget target of tax revenues for the year 22-23 is quite on a lower side, and it would get surpassed quite easily. Then the another aspect where I would like to draw your attention is the expenditure. The government has increased its expenditure, but it is very pleasant to know that the expenditure which has been increasing has been on the capital account front. So India would be creating more assets, more infrastructure, and the investment would be into the core sectors which will give a fillip to the country at large. So the investments into the capital side is increasing year on year, and it is for this increased capital expenditure that we see a fiscal deficit which is in the range of 6.4%, which could have been reduced if that 1.5 lakh crores worth of capital expenditure increase would not have been announced. But that is something which is welcome, especially in the times when India needs a lot of investments on the infrastructure side. This is the trend in which the deficits and the fiscal deficit of the country has been moving. This fiscal deficit is a very important parameter in understanding the way the interest rates would be moving in the times to come. The way there has been a larger allocation of capital expenditure, there has been comparatively a larger fiscal deficit, and the fiscal deficit is nothing but this is the amount which the government will have to borrow in the form of selling government securities, and that will increase the rates of interest. And after the announcement of these figures, the rates of interest on the government securities have spiked up since last 4 to 5 days, which indicates that this is the way. If the fiscal deficit would remain like this, then it is fine. But if it increases more than what it has been provided, then this might lead to an increasing rate of interest, which is going to impact the way the cost of funds would be to the consumer and to the industry. Now, the trends in the tax receipts, I have made 2 circles that tax receipts as a percentage of GDP. So in comparison to the gross domestic product, what is the gross domestic product? Gross domestic product is the income of the entire country, is the gross domestic product. Then in comparison to that, what are the tax receipts? So as a percentage of it, in the year 21-22, it was expected that it would be 9.9% of the total GDP. So out of the total earnings of the country, 9.9% would be the income of the government by way of taxes. And for the as a pleasant surprise to the government, maybe not a surprise, but on account of a lot of good efforts by the government, this tax to GDP ratio is 10.8. So there is an increase of around 1% of the GDP by way of tax collections. So this is standing to a great advantage to the government for its augmenting of its resources. Even in this year, the GST collection is improving, and we can see from this graph that the moment there was a sharp lockdowns or those kinds of disruption, there was a sharp decline in the GST collections. But the moment the economies rebounded, the entire activity in the economy rebounded, the collection on the GST front, which is a good indicator as to how the economy is functioning, has shot up, and the collection of GST for the month ended January has been a whopping 1.38 lakh crores. So anything more than 1 lakh crores is something which is very much, the government is quite pleased to see it. And this is now increasing on a sustained basis. And the last collection, as we can see, has been 1.38 lakh crores. So this is going to be to the advantage of the government finances. As I was talking in the budget figures, that the capital expenditure is on an increase. The capital expenditure in the dotted line is on an increase. And the another important and an aspect which is so very much appreciable for the way the government finances are being run is that the revenue expenditure is getting decreased. So every year when we used to talk of budgets, say 5, 7, 10 years back, every year the revenue expenditure in the union budget was always increasing. The salaries, the way the entire government machinery was managed, which was the revenue expenditure, those revenue expenditures were getting increased year by year. And this revenue expenditure now, since last at least 2 to 3 years, is on a declining side, which is something which we need to appreciate. Now we will go to one of the most important part of our presentation as to the changes in the Income Tax Act. What all changes have been proposed in the Income Tax Act? The first and foremost change for which there has been a lot of discussion, and there was a mention of it by the finance minister in her budget speech as well, was the provision of filing updated return. So now an SSC can file an updated return. Any person who had originally filed a return or did not file a return can file an updated return. But if he had not filed the original return, and if there is a tax which he is supposed to pay under the updated return, then he would be subjected to a penalty under section 234 capital F, which is that 5,000 or 10,000 rupees. So that is the penalty, that as such you were supposed to file the tax return, but you did not file. Now when you are filing that updated return with those taxes, then you are supposed to pay the penalty. But if you had filed the original return, then this penalty would not come into play. Now, what are the statutory dates for the way this updated return, the entire mechanism is going to work? Let us take a case of the financial year 21-22. So the year which is going to end on 31/3/22, that is the financial year 21-22, which is assessment year 22-23. So the due date of return for SSCs who are not supposed to get their account audited and etc. would be 31st of July 22. Now the time allowed under section 139(4) to file a belated return. So my due date of return was 31st July, but for some reason I could not file. Then I can file a late return, which is called a belated return under section 139(4). And that I can do by 31st of December 2022. Now, if I had filed the original return in time by the due date, then I can even file a revised return. That if there are certain things which I would find that there are some omissions, some corrections, some things which I need to rectify, then I can file a revised return by 31/3/23. Now all this updated return and revised return, the reason why it has gained the prominence is that in the last 1 year, there is an availability, or there is the website of the income tax has been supplying annual information statement. Under the annual information statement, all the transactions, or quite a wide range of transactions which a SSC would have undertaken, are known to the government, and it is brought forward to the SSC that these are the transactions which you have undergone. And when the SSC scrutinizes these transactions, and if he feels that there are certain things which he has been missing out, then he should take an opportunity to revise his return and correct his position, because this is the information which is already available with the income tax department. Now, what happens is that if if the date of filing that revised return has already elapsed, it has gone, right? But now it has come to my knowledge, come to my mind that I want to correct my filing and I want to come clean by filing an updated return. Then I can file an updated return in respect of the year ended 31/3/22 by 31/3/24 by paying an additional tax of 25%. And I can still file that updated return showing the correct position of my income by paying 50% additional tax by 31/3/25. Now, how will this additional tax be calculated? So what we need to do is that what is the tax, surcharge, cess, interest as per the original return, and what are the rebates, prepaid taxes, prepaid interest as per the original return. Find out that figure, right? So this is the amount which was payable as per the original return. Now, what is the amount which you are supposed to pay as per the updated return? Now, as per the updated return, obviously, there would be an increased amount. So this increased amount, which would include a summation of tax, surcharge, cess, and interest, minus all those rebates, prepaid taxes, and prepaid interest. So whatever is that additional money which I am supposed to pay on all these counts, I need to pay 25% as an additional tax on this additional amount which I am as such supposed to pay on this count. Now, who cannot file a updated return? If it is a return of loss, if the original return is a return of loss, or even say if I want to file an updated return as a return of loss, no, I can't file that updated return of loss. I cannot file a return where I would be reducing my tax liability. I have to pay an additional tax, or I cannot file a return where I would be reducing my tax liability. I cannot file an updated return if there has been search, survey, or proceedings under section 132, or assessment proceedings have been completed or have been initiated in my case. So the basic principle is that if the income or the escaped income or the income which was supposed to be declared has not been detected, or the proceedings of detection are not going on, then only you can come clean suo moto and file this updated return. And the updated return, if it is once filed, you cannot further file or furnish a revised updated return anymore. Now, another important change which has happened under the Indian Income Tax Act is a change in section 68. This is a very important change, and this could impact a large amount of people who are into business and profession, and people need to take a note of this. Section 68 says that if any amount is found credited in the books of account of any assessee, then he does not offer an explanation as to the nature and source of this credit, or if the explanation offered is not satisfactory to the assessing officer, then that income would be charged to tax in that relevant assessment year. So this was the provision of section 68. Now, in order to meet with that, how would I discharge my onus under section 68? The judicial principle that has been laid down was that if I prove the identity, creditworthiness and the genuineness of the transaction in respect of the amount credited. So now the amount credited in my books of account will include all those loans, borrowings, gifts, or anything which is standing credit in my books of accounts. So in respect of all those loans and borrowings, it is my duty as an SSC to satisfy the assessing officer about the identity, creditworthiness of the person who has given me that money, and genuineness of that transaction. That was good enough. Now, with effect from assessment year 23-24, so which is financial year 22-23, it has been provided that in respect of loans and borrowings, the additional aspect of explaining the source of funds of that creditor has also now been casted under section 68. So if I have taken a loan from somebody, and if I just provide the identity, creditworthiness, and genuineness of the transaction, which it used to be earlier, that is no more enough. Now I have to provide the source of fund of the person who has given me the loan, and it is my duty to satisfy the assessing officer. So this is an important change, and this is going to create a lot of difficulties for people who, if they find it difficult proving the source of the source. So here my source is the person who has lent me the money. Now here is a situation where I need to even prove the source of the source. And the consequences of the violation of section 68 are really draconian. The moment if there is an addition which is made under section 68, then I would be subjected to a tax of 78%, which includes tax plus surcharge. And if I have not disclosed it in my return of income, there will be an additional penalty of 6%. So it will be 84% if the assessing officer figures out that I have not been able to satisfactorily prove the source. Now, there have been small changes that if in case TDS or TCS has been paid late and there is an interest which is payable, so whatever is the amount of interest which is calculated by the assessing officer in his order is the amount which is considered to be final. Then one more provision, which is the way it used to exist, was that if I am supposed to make any TDS, tax deduction at source, and if I'm making the payment to somebody who has not been filing his tax returns since last 2 years, as per the or within the prescribed date under section 139(1). So even if he is filing, but if he is filing late, then it doesn't work. He has to file in time. So when I'm making a payment to somebody and I'm supposed to make a TDS, the person to whom I'm making the payment have to be a regular tax filer since last 2 years. That has been the provision. And now that provision has from the 2 years with effect from 1st of April 22, it is just a requirement of 1 year. And if in case if that person is not a regular filer, as I have been talking, then the TDS rate would be the double the prescribed rate or 5%, whichever is higher. And there are certain exceptions, there are certain provisions for which these provisions would not apply, which I have mentioned. Then in case of immovable property, as we know that there is a rate of TDS at the rate of 1% when the sale consideration is exceeding 50 lakhs. Now the change which has been made is that is not just the sale consideration, but sale consideration or the stamp duty value, whichever is higher, TDS is supposed to be made on that higher value. Now, if there are any benefits or perquisites which are given to any party with whom I am doing some business, and for that person that is a business income, then it will be subjected to a TDS. Just to put an instance, say if there is a company which rolls out a scheme that if you to its business associates, that if you achieve a certain target, we'll give you a foreign trip, a car or something. So what used to happen was that these respective companies would debit those expenses for that car or that foreign trip in their expenses, but the people who received those benefits in cash or in kind did not reflect it as their income. Now there is a provision of TDS which is supposed to be made on these incomes. So the incomes would automatically get reflected in the 26AS form. So those incomes, which is the value of that perquisite which has been given, have to be now offered to tax for sure. Then there has been some change in section 94, where it has been provided all these years that if there is a dividend stripping or a bonus stripping and a loss is artificially generated on account of this dividend stripping or bonus stripping, these provisions are now extended to transactions of InvITs, REITs, and alternate investment funds. Then there was a provision which existed, was that that in case of a private limited company, if there is a tax liability of a private limited company, and in certain circumstances, if the private limited company is not able to discharge its tax liability, then the directors of that company are jointly and severally liable for the liability of the private limited company. The title of that section read was that liability of directors of private limited company in liquidation. But the fact of that section was that it's not that the company has to be into liquidation, even otherwise that liability is always there, and that word in liquidation on the title has now been omitted. So now it is very crystal clear about the director's liability, and there can't be any two opinions or two thought process about it. One more change which has been brought about is that in case of capital gains, short-term or long-term, on account of sale of listed equities, there was a concession that in respect of the surcharge which is levied on those transactions, say till 50 lakhs, the surcharge is nil. Between 50 and 1 crore, it is 10% on any incomes for that matter. 1 crore to 2 crores, it is 15%. And thereafter, between 2 and 5, it is 25%. And more than 5 crores, it is 37%. So there was a concession which existed that when it comes to capital gains on these listed equity shares, either short-term or long-term, the maximum rate of surcharge would be levied, would be 15% and not more than that. It would be either nil, 10, 15, but not more than 15. But when it came to other assets, like if there is a transaction of real estate or unlisted shares or anything, then it would get escalated to that to the extent of that 37% even. Now there has been a level playing field, that short-term capital gain, long-term capital gain on listed equities, even dividends, and even any kind of long-term capital gain, the maximum surcharge that is supposed to be paid will be only 15%. Then this is an important change or a clarificatory change which has been brought about. Section 37(1) of the Income Tax Act provides that any expenses which are made for, which are wholly and exclusively for the purpose of business, they are deductible. So there is a very wide section. So any expense which is made for the purpose of business, which is wholly and exclusively for it, they are deductible. So people used to claim all sorts of deductions, and for that there was a provision, or rather an explanation which was provided to section 37(1), which read that if the expenses are expenses on account of violation of any law, then those expenses would not be allowed as a deduction. So that was which was provided under explanation 1. Now, despite the fact that this explanation was existent, and there are certain events which happened in last 3-4 years which necessitated this change. What happened is, in the year 2009, in respect of the doctors, the Indian Medical Council issued a circular that all the amounts that a doctor might receive by way of gift, travel facility, hospitality, cash or monetary benefit from a pharmaceutical company or anybody from the health sector industries, they are not allowed to receive it. So that was in violation of what has been laid down by their medical council. So that was done in 2009. In 2012, the Central Board of Direct Taxes issued a circular which said that now if these expenses are debited by anybody on these counts and payment to these doctors, then they will not be deductible. But various courts held various opinions, and now it is settled to rest that any expenses which are made by way of any violation of law, and even which is not in accordance with the conduct of that profession or that business, they will be considered as payment in violation of law, and they would not be deductible for the payer. So this is the change which has been effected and made and laid to rest, that henceforth, if any amount is paid by way of any gift, travel, hospitality, cash or anything, or any referral, then it would not be deductible to the payer. Then in respect of surcharge and cess, there were some interpretations of some courts that these amounts are not in the nature of tax and they should be allowed as a deduction as like any other expense. It has now been clarified that these expenses are a part of tax and they would not be deductible. Then under section 14 capital A, it has been provided that if there are expenses which are incurred against an exempted income, then those expenses are not allowed. But even if those expenses are incurred and the exempted income is accruing, and if somebody says that, no, I didn't receive any income in the current year, but if there are exempted incomes which are accruing, still those expenses would not be allowed. Then in case of faceless assessment, there was a complaint or there was a dissatisfaction for people that I should be granted a personal hearing to express my position. So now the moment if somebody asks for a personal hearing or a taxpayer requests for a personal hearing would be granted by a video conferencing or a video telephoning. So it would not be as such a physical in-person hearing, but they would be able to put forward their point by way of video conferencing or video telephoning. One more change which has been now incorporated is that there is a lot of filing of appeals on the similar matters which are as such pending in the higher courts, but because that matter has not been decided in the higher courts, the filing of those appeals go on repetitive basis. So in respect of any SSC, if those appeals are undecided, no further appeals would be filed till the time that original appeal is decided. And now if in a similar case, if the appeals are pending, still those appeals would not be filed till the time that appeal is decided. So in a nutshell, what is important is that this will lead to a lesser clogging of our judicial system, wherein appeals and repetitive appeals are not filed and they would be put forward before the court only when they are required. Then this is not something which has been a part of the finance bill, but I thought it is quite important. There is a recent circular, wherein it has been clarified that where any payment under section 194Q or 206C, which is sale of goods or purchase of goods, and there is supposed to be any TDS or TCS, the amount before the GST amount is something which is subjected to TDS or TCS. And so now it is settled that for all the TDSs and TCSs, the GST or any other indirect taxes are not to be considered. Amounts before the GST or indirect taxes is the amount on which TDSs and TCSs are supposed to be made. Then there are some very important changes when it comes to the taxation of trusts. There is a flat rate of 30% which has been provided on the taxation of trust in certain situations. The situations, if we if I illustrate those situations, that if there is an accumulation which has been sought by the trust and it is not allowed, then that entire income is taxable at that rate of 30%. Then if the amount of accumulation which has been sought, that in this year I am not able to spend, I will spend it across a period of 1, 2, 3, 4, or maybe maximum 5 years. And if it doesn't get spent across those periods, then those unspent amount is also subjected to that 30%. If investments are not in accordance with section 11(5), if those investments are made at investment options which are not in accordance with what has been provided in the Income Tax Act, the entire amount of that investment would be subjected to 30% tax. If incomes are applied or are spent for specified persons, this is the trustees and the relatives, or these incomes are applied outside India, even then it will all be taxed at 30%. So this is a freshly, newly inserted provision which all trusts should take note of, that now there is a rate of 30% on these violations or these situations. It will lead to this kind of a 30% tax. Then as far as cancellation of registration is concerned, there have been some very important provisions which have been made, that if the application of income is not in accordance with the objects of the trust, if the trust is carrying out activity which is not incidental to the objects of the trust, or if it is carrying out any incidental activity, so charitable activity and some kind of a commercial activity, but then that commercial activity has to be incidental to the object of the trust, and for that separate accounts have to be maintained properly. If that is not done, it might lead to cancellation. Then if the trust is for a particular religious community only and doesn't benefit the public at large, then also this cancellation can take place. Then further, if the trust is not found to be genuine, and the conditions as laid down at the time of registration or any court order in respect of the trust has not been followed, still in those circumstances also the cancellation of registration would get triggered, and an opportunity of being heard before the cancellation would be provided to the trust. These things weren't so very focused, so very strict when it came to the provisions as they existed earlier. Now the way the entire Income Tax Act is being administered for the trust is on a very different footing, and all those trusts which are not in sync with an absolutely crystal clear, clean slate, they are all going to face difficulties if they are not managed properly, or if their activities are not, to be precise, of a charitable nature. Then in case of the accumulation, if the way it has been say sought for 3 years, or say 5 years or 4 years, that accumulation amount has to be spent within that period. And earlier it used to be say that I have sought accumulation for 3 years. So if I have not spent that money by the third year, then it would be taxed in the fourth year. Now it would be taxed in the year in which the accumulation is expiring. So then if I have sought an accumulation for 3 years, then if that unspent amount, it would be taxed in the third very year, it would be taxed. It will not go to the fourth year as it used to be earlier. Then all expenses claimed by the trust have to be paid. It is not that on a mercantile basis, if I just I've just obtained, or I have just got the bill, maybe I've got the charitable activity done even, but it has to be paid. Only then it would be allowed as an expense when it comes to claiming those expenditure and demonstrating that this is the income which I have expended. Then all those trusts which are not fulfilling the criteria that the commercial receipts should not be in excess of 20%, they are not getting their books of accounts audited, or not filing their returns as per the provisions of law, their deductions or their exemptions would be curtailed very substantially. So this is a very major change which has happened in respect of taxation of trusts, and all those people who are now administering the trust have to be very vigilant and very focused in their entire operations. Then the provisions which have been discussed a lot in the social media and in the media, and the discussion goes on, is the taxation of virtual digital assets. Now, these virtual digital assets are the ones which have been defined, and which includes cryptocurrencies, NFTs, and several other things. And the government has said that will notify at appropriate time what would be a part of virtual digital currency and what would not include as virtual digital currencies. So this taxation is on virtual digital currencies, which, as I said, would include cryptocurrencies and NFTs and everything. And this taxation would happen from the assessment year 23-24 on these lines, that is after 1/4/22. That by no means mean that whatever transactions which have happened till 31/3/22 are not subjected to tax. The transactions after 1/4/22 will be subjected to tax in this manner. That is what has been provided. So whatever transactions have happened till 31/3/22 would get governed by the general principles of taxation which existed till 31/3/22. Now, what has been provided is that the gains of this virtual digital assets would be taxed at a flat rate of 30%. No expenditure would be allowed as a deduction except the cost of acquisition. No loss will be set off on any other activities from this income, nor the loss of this activity would be carried forward, or one would get a set off in any other income. Obviously, if I have undertaken, say, 10 transactions of virtual digital assets, 5 I have earned something, 5 I have lost something, then that netting would happen. But if the net result is a loss, I will not be able to claim it against any other income. That would remain in that calculation itself. It will not go out, nor losses from outside, some other activities, I'll get a set off in computing this income. Then there will be a provision of TDS on all the transactions at the rate of 1%, and whenever the transfer happens, and that is to be paid by everybody who is making a payment on account of transfer of any virtual digital asset, which is in excess of 50,000 for specified persons who are specified persons, I have laid down, and for 10,000 in any other case. So that is the TDS which everybody who is either a specified person or not a specified person. And the moment it exceeds these thresholds, they are subjected to TDS. Then if there is a gift of any of these virtual digital assets, then section 56(2)(10) has been appropriately amended, that if it exceeds say 50,000 rupees, then whatever is the consideration, or if it is an inadequate consideration, then whatever is the value of that asset which is transferred will be subjected as a part of the receipts under section 52(10). So whatever is the value, say if I am receiving a gift of any virtual digital asset and that I am receiving from somebody is not my relative, then it will be subjected to taxation in my hands to the extent of 50,000. It is free, but the moment it exceeds 50,000, then the entire amount is taxable in my hands. The discussion which has been going on is that, does this make the transactions into this virtual digital assets legitimate? It has been clarified by the government that taxing something does not make the transactions as such legitimate. But if there are transactions which are happening, then we would like to tax it. And just to put forward the basic principle of the income tax law is that any income which somebody derives by way of maybe some violation of law, by legal, illegal, whatever means, if it is the income, then it is subjected to tax in the hands of the person who has derived that income. So income is always taxable, of whatever color, whatever violation, it doesn't matter. So here also they say that taxing these transactions doesn't mean that these are now something which have been given a color of absolute legitimacy. There would be a different set of laws which would operate and which would be enacted at an appropriate time. Now, presently, what has been done is that it's not that cryptocurrencies or NFTs or something, it's virtual digital assets which are subjected to taxation. So now when it's virtual digital assets, then what can happen is that anything which is a virtual digital asset, so that would be subjected to say taxation. It might not be a cryptocurrency or an NFT. So that also will fall under the ambit of virtual digital asset. And the government has been saying that rather than collecting some tax by way of TDS, the provisions of TDS has been instituted to see, and the provisions of taxation have been instituted to see that what is the depth of this market and gain more information about this market. So in a nutshell, this budget is a growth-oriented and a futuristic budget. Yes, it has a larger fiscal deficit, but the government is placing a lot of confidence in the Indian economy. As far as the taxation part is concerned, the budget offers a lot of stability. Whatever changes have been made for the smooth functioning of the law and the dynamics of the time. The taxes are, when we compare it with the global rates of tax, they are quite reasonable. There is a lot of compliance which has been happening. And the most important part is that in earlier times, it was always a scenario where the government used to rob the rich and benefit the poor. They would say, there are people who go on talking that there has to be a wealth tax and whatnot. So those situations would lead to that people who are taxpayers, who are working so hard to earn money, they are inflicted to more and more of taxation, rather than what the government is doing, that they are trying to see that wherever there are loopholes in the entire tax administration, they are getting plugged. So the focus of the budget is on capital expenditure, and there is a reduction of revenue expenditure, which are very important aspects. The figures in the budget, as I was talking when we are talking about the tax revenues, they are quite conservative, as is being observed by so many people who understand these things quite well. And the PSU disinvestment target has also been put at a very conservative level. So after so many years, now is the time when the earlier people used to say that these budgetary figures are not achievable. Now are the times that the government is putting figures which are quite conservative. So when somebody is preparing any financial statement, and if the figures are conservative, they are always quite welcome. So with these words, when it comes to the Indian economy and what the Prime Minister's message has been on in the World Economic Forum, has been that India's strength is democracy, which a country of India's size and emerging economies, it is a strength. The demography, the people, the hands, the young population, which can lead to a lot of manufacturing and lot of demand for goods and services. That's our strength. And the decisiveness with which our present government and the administration is working are the strengths of the Indian economy, and we all need to be proud of it. And with these words, I end my presentation. I would like to thank everybody who has participated through this Zoom and YouTube. And I would especially like to thank my own team of Ashutosh FinServe, who work so hard and who have been on my side, helping me to decode everything in 4 or 5 days, which is a marathon exercise. Day and night, they are by my side. Since all these years, they have been fantastic, and they have been working with me, equipping me to put forward this entire comprehensive presentation. I really thank them. And we are available on the website. You can be in touch with us on the social media platforms. You can stay connected. And whatever I have been stating are my personal views. And wherever we have quoted some data, we have put forward the references. And before acting on any of these subjects, take appropriate professional advice, which is in sync with your facts. And we would be appreciative if you can give us a feedback on the WhatsApp numbers which have been mentioned, and we can stay in touch with you and keep you updated on finance, taxation, and NRI regulations related aspects of whatever we have been researching, whatever we have been sharing and disseminating in terms of information and knowledge. Thank you very much. And I will take a few questions if they are.